Welcome back to the channel. Today we're chatting all things Coastfire because recently on our Instagram I announced that we have reached Coastfire. And I think Coastfire is one of the most underrated forms of financial independence out there because it's one of the easiest ones to obtain. Reaching Coastfire means that our investments have reached a point that we could stop investing. We have enough invested now that that amount could compound enough to be a fully funded retirement account. In this video, I'm going to explain what Coastfire is. I'm going to show you how to calculate it in a few different ways. And then I'm going to share our real life example so you can see how it all works in a real life situation. So what is Coastfire? Well, Coastfire is a variation of FIRE, which stands for Financial Independence Retire Early. The concept of traditional FIRE is all about having enough invested so it can cover your living expenses, and when you reach that point, you can essentially stop working. Whereas Coastfire is all about reaching a certain amount invested before that amount and then just letting it sit and compound over time so that it can be enough for when it's time to retire down the track. This is not financial advice. I'm a teacher. This is educational content. I'm explaining what Coastfire is. I'm using our real life example and our numbers to explain it even further. So let's jump back into it. Now for Coastfire, we do need to know our financial independence number, which is 25 times our annual living expenses. And again, this number tells us how much we would need in a traditional early retirement. But again, we do need to know this number to help with calculating our Coastfire amount. So for us, our annual expenses is $138,000 a year. And when we multiply that by 25, we get $3 million. Although we are working towards decreasing that amount. So we're currently trying to spend $10,000 a month so that our annual spending is $120,000. And then our FIRE number then goes from 3.5 million to 3 million. So that also shows why it's important to look at not just how much we're putting into our investments, but how much we're actually spending. Because the less we spend, the less we need. Now, the FIRE number is based on the 4% rule, and the 4% rule was determined to be a safe withdrawal rate from a study called the Trinity Study, which found that a mixture of diversified stocks and bonds portfolio could sustain roughly a 4% annual withdrawal rate over a 30-year period without depleting the capital. Some people like to use a lower withdrawal rate, say 3.5%. Some people are actually starting to use a higher withdrawal rate because this study was based on stocks and bonds, where most people these days are mostly investing in stocks, which generally results in a higher return over time, depending, of course, what's happening in the stock market. And of course, we know that returns are not guaranteed. We can just look at historical data to help us make some predictions. Now, I mentioned before, one of the reasons why I like Coastfire so much is because it's the easiest one to attain. And the earlier we obtain it, the less that we actually need. And this is because compound interest has more time to do its thing. Coastfire is simply that the money is coasting along, growing over time, and we're just cruising on into retirement or even hopefully early retirement. Another reason why I like Coastfire so much is I like to see it as a retirement emergency fund. Just like an emergency fund gives us a financial buffer for the unexpected in our annual budget, if something goes wrong in the here and now, there's money there to help us out in our emergency fund. I like to think of Coastfire as giving us a similar sense of security, but for our retirement. We've built up enough invested now that if something was to happen to us in our incomes and we couldn't contribute more, we have our retirement taken care of. It's a little bit like our retirement security blanket. Now for Coastfire, we do need to know obviously how much we have invested. So let's have a look at how much we currently have invested in the stock market and in our retirement account. So both my husband's and mine. I actually have more than him, which is quite unusual considering he's older and I'm female, but I do have $418,100. I have rounded that down to the nearest hundred. My husband has $350,700 in his superannuation. And then in the stock market, we have $231,800. Well, that was at the time of filming this, which was Wednesday, the 19th of August. So that means we currently have just over $1 million invested. And yes, we do have an investment property, but I'm not including it in our Coastfire number or our financial financial independence number, because at the moment it's actually costing us money, and it's actually making us need more in retirement. It's costing us maybe about $10,000 a year at the moment. So that's making our fire number even bigger. So I haven't included it at this point in time. Once it's positively geared, then I think I will include it. But at the moment, it's actually not helping at all. Now, of course, there's some equity in there and we could use the equity, but the real issue is here, we don't plan to sell the investment property and use the equity. Eventually, we want to use the rent as cash flow, but let's have a look at the equity anyway. It's currently valued at $1.1 million and it has a loan of $936,000 on there. So essentially, we have an equity of potentially $164,000, but that's before selling costs and tax, of course. And so once we look at taxes and the selling fees, I just don't think it's worth putting into our financial independence number at this point in time. Hopefully, not soon, but maybe in a few years, it's positively geared and we can use that in our financial independence number then. Now, I mentioned this Coastfire grid many, many years ago, and I'm going to share it with you. Now, it is a little bit conservative in its numbers, and we'll chat about that. But what I also need to mention is that some of the annual spending is a little bit low, well, for what we spend anyway. So we'll have a look at the grid, and essentially I'll just have to double the annual spending and double the amount needed. So this is the Coastfire grid from Wallet Burst. Now, it's basing this off an 8% growth rate, 3% rate of inflation, and a 3.5% withdrawal rate. So that's a little bit lower than the 4% rate we were talking about before. Now, what this grid is using is a retirement age of 67, but I'm preferring to use a retirement age of 60. So we do need to keep that in mind with the numbers. So as I said before, that the annual spending is only going up to $100,000 because this was made quite a long time ago. So if we're looking at our $138,000 of annual spending, I'm then looking at $70,000 in annual spending, and then I just need to double those amounts. I am currently 40, so I would need double $536,000 invested to be on track for Coastfire. Although I want to retire before that, I want to retire in 20 years' time. So that would be 67 take 20. So if we just look at 48, age 48, we would need $718,000 times 2 invested, lowering our annual spending down to $120 a year, so $60,000 doubled. We need much less. So that is the goal we are working towards. So $459,000 twice, which we have achieved. But if we're looking at retiring at the age of 60, it's $615,000 times 2, which we haven't achieved because, as I was saying, this is quite conservative and I feel comfortable using a 4% withdrawal rate. So I've shared my Coastfire cheat sheet. It is based on a 7% return, which I feel is conservative. It doesn't include an inflation amount, but when I use a 7% return, I feel like it is factoring in a little bit of inflation because over time, the stock market has generally returned just over 9%. So if we're using 7%, we are allowing for 2% inflation, depending on how everything's moving and going. So then in my grid, we have years to retire and annual spending. If we're spending more than 140K, I'm spending 160K a year, then we would need to be looking at 80K a year and doubling that amount. So once again, the less we are spending, the less we need. So if we're looking at 20 years to retirement, I will be 61. That's $775,000 needed for $120,000 a year. If we're keeping that other amount of $138,000 a year, it's $905,000 needed, which we have achieved with that amount that I shared before of just over $1 million. Now, I think some of you might be thinking, yeah, right, okay, then how are we getting 9% return over all that time? Now, I'm always checking in with my superannuation fund. I'm always looking at what's available, and there is things available that do get higher returns. Obviously, those higher returns need to suit the person and their risk tolerance. And I'm just going to go through what my superannuation fund has and show you that there are some options that are returning higher than 7%. So in my fund, there's a high growth option that has returned 9.83% per annum over 10 years. The balanced option has returned 8.47%. Now, there is the high growth index option, but it's only been around for 1 year with my fund. So that only has the 1 year return, which is 10.2%. That is one that I'm keeping my eye on. And then there's the individual asset class options. So the Australian Shares Index has returned over 9% over 10 years. The International Shares Hedge Index has returned nearly 11.5% over 10 years. And then the unhedged version of the International Shares Index has returned just over 12.5%. So these returns are possible. And that's why I'm always checking in with my superannuation to make sure that what I'm investing in is matching my investing timeline and my risk tolerance, of course. Now, let's get down to the Coastfire formula because it is a little bit complicated. It's a little bit more complicated than the 25 times your living expenses. That's why I like to use that grid, the cheat sheet. I also like to use a compound interest calculator, which we'll also chat about soon. But here is the formula. Now, the formula I've just put into Excel to help me calculate it because my calculator didn't have all of these buttons, but this is it. It is our FI number divided by, in brackets, 1 plus the growth rate to the power of years to retirement. So if I'm going to use my 7% investment rate, my growth rate would be 1.07. So the formula for us is our FI number 3.5 million divided by 1.07 in the brackets to the power of 19. So 19 is how many years till retirement, which has me retiring at the age 60. So with this formula, we need $967,000 invested. And we have reached that because we shared earlier my superannuation, my husband's superannuation, our investments outside our stock market investments. Hopefully one day we can add our real estate, well, not our real estate portfolio, our one investment property to that number. But as I said earlier, not at the moment. And if you've known me for a while, you know that I love playing around with compound interest calculators, especially the ASIC's Money Smart one. So if we play around with a compound interest calculator, I just put in what our Coastfire number was, but I could also put in what we currently have. We are not depositing anymore, but obviously with the way Australia works and the superannuation system, it's impossible nearly to not contribute more. But anyway, we move on. And then I want to retire in 19 years' time, 7% investment rate. And then we can see down the bottom that, yes, I would hit my FIRE number of $3.5 million. So using a compound interest calculator is another way to work out how you are tracking and how much you might have. And if you put in what you have, how long till retirement, and if it reaches your FIRE number, then that will tell you that you have reached Coastfire. We've reached Coastfire, so what's next? Well, our next goal is to reach Coastfire, but with our investments inside our superannuation, because I just feel like that increases our financial security even further. As I said, our emergency fund retirement plan. So once we reach Coastfire within our superannuation funds only, that frees up those other investments to give us some more flexibility in the here and now, which is something I'm itching for at the moment, because we can start thinking about how we're going to use that money to retire early, so before 60, or we could also use that money to think about working less, because essentially we don't need to keep adding more to our investments. So we can dial down how much we're earning and work a little bit less. Or we could even consider taking a career break, which is looking very, very, very tempting at the moment. Also on Instagram, when I shared about reaching Coastfire, I just also shared how we're tracking for the other types of financial independence. Now, these percentages that I have here are actually based on that $3.5 million FIRE number. Soon, once we've consistently spent $10,000 a month, I will look at changing our FIRE number to 3 million, but we're just going to keep going with this 3.5 FIRE number for the moment. So actually the percentages could be better, but anyway, and if you want to know more about these type of financial independence, let me know and I can make a separate video. But Barista Fire, we're 62% of the way there. Flamingo Fire, 57% of the way there. Lean Fire, 53%. Traditional Fire, 28%, which feels like a long way away. And then Fat Fire, which is not something that we are aspiring to, is 14%. That's it for today's video. If you have any questions, pop them in the comments. Otherwise, I'll see you in the next video.